Hi, my name's Jose Chavez. Trying to predict the markets over the short run is tricky business, but keep in mind, the market is forward-looking mechanism. Over the long term, it gets a little easier. The markets go up about 4 to 5 times as often as they go down. The media proved how difficult it is to predict elections in 2016. Forecasting how an election may impact the markets during a pandemic and on the heels of a recession, well, it's quite an undertaking, but here we go. We start by saying that the president often gets too much credit and too much blame for the stock market. The market really doesn't care about what one person does, but does largely care about earnings. In the US, earnings largely represent consumer spending. We make up 2/3 of the economy. Consumers spend if they are employed. So, in an indirect way, what the president does to put people to work does drive the market and the economy. But these policies take time to play out. Also, the president doesn't always have control of unforeseen events like the pandemic. Shown here, the presidential election cycle theory, initially theorized by Yale Hirsch, states that we can time the markets based on where we are in a president's term. This data suggests that investors should invest in the stock market on October 1 of the second year of a president's term and sell on December 31 of their fourth year. While the study provided a trend, it hasn't always been true and forgets an important part of our investment philosophy, diversification. While the data tells a story, the returns are positive in all years, and the difference is negligible in the best year compared to the worst year. Now that we have some historical context surrounding election cycles, how will this presidential election impact the markets? Unfortunately, the consensus seems to be that there is no consensus. Some economists believe that the market favors Trump's low taxes and light regulation, while others on Wall Street believe Biden brings more stability, calming the markets. Perhaps the biggest threat to the market is the unknown, but most expect a disputed election due to the pandemic and the pre-election focus on election rigging and mail-in ballot concerns. Many economists believe that markets have priced this in, and it should mute the impact of a disputed election when compared to the 2000 dispute over hanging chads in Florida. During that 6-week standoff, the market retreated 12%. The biggest fear we have heard is what might happen if a Biden presidency is paired with an increase to both the corporate tax rate and the capital gains tax rate. Now, getting things done in politics is never easy, but when legislation changes do occur, the impact these changes have on markets lags significantly. Now, this chart details how the stock market, as represented by the S&P 500, has reacted to past tax hikes. Look, it may surprise you, but it is different this time. It is, but then again, every time is different. We are in a pandemic, and that could sway things one way or another, but the headwind of the pandemic is contrasted by the tailwind of cheap money. With cheap money from the federal government in the form of low interest rates, our economy is poised to recover. Our message to our clients is that we have carefully built allocations around your goals and objectives. If your financial situation has not changed, perhaps your portfolio doesn't need to change either. Make sure to speak with your advisor and consider all of your options. Thank you for your time and your continued trust.